Welcome to our CFP exam prep discussion focusing on a crucial insurance concept, the law of large numbers. Understanding this principle is essential for both the exam and your future practice as a financial planner. The law of large numbers fundamentally explains how insurance companies can predict losses and set premiums accurately. Let me break this down in a way that will stick with you. Think of flipping a coin. If you flip it only 10 times, you might get 7 heads and 3 tails, which doesn't reflect the true 50-50 probability. However, if you flip it 1,000 times, the results will get much closer to that expected 50-50 split. This same principle applies to insurance. Insurance companies use this mathematical concept to predict how many claims they'll likely need to pay within a large group of policyholders. The larger the pool of insured individuals, the more accurate their predictions become. This is why insurance companies want to spread their risk across many policyholders. Let me give you a practical example that often appears in the CFP exam. Consider a life insurance company that insures 100,000 40-year-old non-smoking males. Based on mortality tables, they know that historically, the death rate for this group is 2.3 per thousand per year. Using the law of large numbers, they can reliably predict they'll have approximately 230 death claims in a given year. This predictability allows them to set appropriate premium rates and maintain adequate reserves. A common mistake students make on the exam is confusing the law of large numbers with risk pooling. While they're related, they're not the same thing. Risk pooling is about spreading risk across a group, while the law of large numbers is about the mathematical precision that comes with larger sample sizes. Remember this distinction because exam questions often try to trip you up here. Another frequent error is assuming the law of large numbers guarantees exact predictions. It doesn't. It simply means that as the sample size grows, the actual results will tend to move closer to the expected probability. The exam might present scenarios where students need to identify whether a given insurance pool is large enough for reliable predictions. Here's something critical for the exam. The law of large numbers only works when the events are independent and random. For example, insuring 100,000 homes in the same flood-prone area doesn't follow this principle because the risks are correlated. You'll likely see questions testing this concept, especially in property insurance scenarios. Speaking of exam strategy, when you see questions about insurance company operations or premium setting, consider whether the law of large numbers is relevant. It's often the underlying principle behind why certain insurance practices work or don't work. To really cement this concept, think about a small insurance company with only 100 policyholders trying to offer life insurance. Their experience could vary wildly from year to year, making it impossible to set stable premiums. But with 100,000 policyholders, their claim experience becomes much more predictable, allowing for more accurate premium calculations and better risk management. Keep in mind that the CFP exam loves to test your understanding of how insurance concepts apply in real-world scenarios. So don't just memorize the definition. Understand how this principle affects premium setting, risk assessment, and the overall stability of insurance operations. This knowledge will serve you well both on the exam and in your future practice.